Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at the growing dominance of private credit as traditional banks face stricter regulations.
Plus, we'll discuss the evolving role of quantitative finance and artificial intelligence in asset management.
And we begin with some of the best interviews from our live broadcast this week at Bloomberg Invest. There, we talk with leaders in asset management, banking, wealth, and private markets in the heart of New York's financial district.
For our first conversation, we are joined by Marc Mahaney, Senior Managing Director at Evercore ISI. We discuss the state of the tech sector and how artificial intelligence is reshaping the industry. We first ask Marc about how AI compares to the launch of the internet.
I don't know if it will be that transformative, but the amount of money that's going into them, paid by companies, put in by companies that have plenty of cash, is something of a tell. And then we've seen a lot of examples of what I call ROAI, ROI, return on investment, ROAI. So, we're staring at it right now. Look at what's happened at Meta in the last 2.5 years, how they've turned around their business and and they've dramatically improved their services for customers. That's you and me as consumers. Our news feed has become more relevant because they've used AI to do better targeting, better recommendations, but also for advertisers. The return on ad spend, ROAS, has risen because the campaigns have become better targeted, better better managed. So I've seen a couple of really great ROAI examples, and so I'm not sure it's transformative, but it's definitely improving the performance of these companies, and it shows up in the P&L too. I think you can also look at Google. 25% of their code is now written by AI. Imagine the productivity improvement associated with that. And then Amazon is talking about 25% lower cost to serve in its most advanced distribution centers. I mean, that's why their margins are going to continue to go up. So you're seeing it in the P&L. So I think it's actually a major productivity improvement, and I think this is going to play out for years.
Okay.
When do you think we're going to really understand how inferencing is going to impact us and companies? And when are you going to get me to buy in to an AI story?
Well, I tried to lay out a couple of examples already of where these companies are deploying AI and machine learning, and they have been for quite some time. We've just had a step up, like a hockey stick improvement. You just mentioned Canada, hockey stick inflection up in productivity gains because with these companies. So I'm sorry, I think we're already starting to see it, and I think we're seeing it in.
But do I see it? I mean, maybe my news feed, but will I pay for it?
Well, you want some really specific product examples. I got a really fun one for you.
Okay, into it.
You want to learn languages? There's this wonderful app called Duolingo. You want to really learn a language? Pay up for Duolingo Max, where you can use an AI-generated bot to actually practice your French, your Spanish, your German, your Russian, whatever we need to learn these days. Anyway, and I think you're going to see more of these kind of little one-off examples. But from a company's perspective, anything that produces internal productivity, improves relations with suppliers or customers. I mean, all of that's. I don't think there's one. I don't think there's one AI revenue build, but you'll see a couple of products that wouldn't exist, and I think Duolingo example is one that simply wouldn't exist if you didn't have AI.
How about for Google and a traditional search business? Is AI a threat to Google or not?
Google just put out a blog that said that because of AI overviews. That they're actually seeing more commercial search queries.
Really?
That should raise all of our eyes. So, and I guess I'm not, at the end of the day, not surprised. Google is a company that just consistently improved the product, made the search results faster and faster and more relevant. This just took that up a notch. And so, if they can get you the result you want more quickly, and especially if it's leading to more commercial searches, Google is the one company in the world that knows how to monetize commercial searches.
What do you think is the biggest misconception about AI, whether it's what investors think, what's priced into the stock, or just conceptually?
I think the biggest misconception probably occurred when DeepSeek came out, and there was concern that this would be highly disruptive for the hyperscalers. I actually took the exact opposite view, especially if you're at the application layer, because the infrastructure potentially just got a lot cheaper. So you're going to, all that money that you've spent on CapEx, you're going to get a better return. That money wasn't wasted. You're going to get a better return than you would have had in the past. So I think that's probably the biggest recent misconception I've seen.
For Meta, it's had a great turnaround, as you talked about. What percentage of that turnaround is simply cost cutting versus maybe just stepping away from the metaverse discussion somewhat?
I think it's two or three things. Stepping away from metaverse, focusing on the year of efficiency that Zuckerberg talked about at the beginning of 23, and now it's become the years of efficiency. There has been a mind shift at Silicon Valley. It's not growth at all costs. There's much more of a focus on, so there's a cultural shift I think is probably good. These companies are going through their middle life stages, not crisis, but stages. And as they do that, they should be spending much less aggressively on growth. They should be focused more on profitability than they are. But then the tie into AI is their developers can produce more code with fewer developers. It's not like they need to cut people from this point on, but they can grow, they can sustain growth with less need to add headcount than they did in the past.
Our thanks to Marc Mahaney, Senior Managing Director at Evercore ISI.
Staying with Bloomberg Invest, Paul and I also spoke with Katie Fogertey, Chief Financial Officer at the burger chain Shake Shack, and we discussed the company's growth strategy, pricing dynamics, and expansion plans.
We first asked Katie about the company's strategy and who the consumer is at Shake Shack these days.
We have this amazing real estate strategy, and what we've done is we've put these great community gathering places in a lot of these, great communities. And where we have attracted is just really kind of more of a, I would say, a more a middle income to higher income guest. And we've seen that guest be able to weather a lot more of the economic headwinds than than the low income consumer has been facing. And, what we continue to see is by leaning into our strength, which is delivering a fine casual experience. So we think about kind of bringing all those great guts of fine dining, elevated food, premium ingredients, doing the things that, other, fast casual and QSR just are not willing to do, putting that in an amazing hospitable environment and getting great guest service. That together has been a winning formula to help us outpunch what has been, some consumer headwinds that has been facing the industry. And we are going to continue to lean into that. It's helping us to differentiate and kind of pull apart from the pack. And it's been our strength.
Where are our samples?
I know.
I mean, what is this about? So who are your competitors then?
Yeah.
So if you're a middle and high-end consumer, who would you say is a competitor?
Yeah, I mean, we sell burgers, shakes, fries, I think the best chicken sandwich out there in the business. We view our competitors as being, anybody who, you might consider having lunch at or dinner at. So that is a pretty wide array, and it also can be, food at home. I mean, that can also be, an area where you would have some share of stomach. So, for the vast amount of, of our restaurants out there, we are competing with a lot of people. Now, we are differentiated, and we are kind of in that category of one in the fine casual sector. But at the same time, we know that, people have lots of different options where they can go out to eat.
Katie, there's a lot of concern out there about inflation. If inflation were to come into your business, where would you see it, and how do you plan for that?
So we actually have been navigating through inflationary pressures for a number of years here, and doing so quite successfully. I'll say, we've had wage inflationary pressures. In COVID, it was actually very hard to get restaurant talent in our restaurants to staff and to deliver our food. It was not a desirable job at the time, and we raised wages and had a very competitive and compelling opportunity for our team members. We also introduced tips as a way to compensate our team members as well and give them added benefit. And then last year with California Fast Food Wage Act, we faced through that as well. We've also had on the food side, inflationary pressures that we've been navigating for a number of years as well. But through all of this, through leaning in on our strength, which is, again, delivering that elevated, experience to guests, giving them that, $25, black truffle burger that we are actually selling for $10 and giving them that great value on that side, we've been able to both grow sales and grow margins at a faster pace. Just even last year, we expanded our margins in the fourth quarter by 300 basis points.
So I've never had Shake Shack, but I know, but it looks like I may be able to now in Delta.
Yes.
So, and this really also goes to your expansion plan. So
Yep.
Delta's going to offer Shake Shack burgers on additional domestic routes this year, and that could expand international flights next year. Talk about these expansion kind of plans.
Yeah, I mean, if you look at Delta at its core and what this does, this is an opportunity where we're able to surprise and delight our guests, give them that thing that they weren't really expecting. You have your expectation for what airline food is like, and this opportunity to get a Shake Shack burger and our great. We have a special brownie that we've made for Delta as well through this program. People are just absolutely elated at the opportunity to have that on their flights. And so much so that it's exceeded our internal expectations. We're rolling it out to more airports. You're going to be able to get it, New York, Atlanta, a number of airports, and that will just, probably continue to grow. And if you look at that opportunity, and I can make so many different parallels to how we've gone into an area where the consumer had a certain expectation, and we just really raised the bar on it and outpunched above our weight and transformed what people were expecting from, it's airline food, if it's roadside food, and across the board.
Katie, in terms of growth, how many locations do you have today, and what's your outlook for the next year or two?
Yeah, we have, across both our company-operated and our licensed business, we're, about 550, 570 locations, but we are growing very fast. We're going to add another 45 domestic company-operated Shacks this year, and we're going to open about 35 to 40 licensed Shacks as well. Those licensed Shacks are ones that we operate, that our partners operate. We have locations in the U.S., but most of that is kind of outside of the U.S. in Asia, and we have UK, the Middle East, Mexico, and most recently we opened up in Canada.
Our thanks to Katie Fogertey, Chief Financial Officer at Shake Shack.
Coming up, we'll break down how private credit is being impacted as banks face stricter regulations.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We continue with some of our best interviews from our live broadcast at Bloomberg Invest. We talk with leaders in asset management, banking, wealth, and private markets in the heart of New York's financial district.
In this conversation, we spoke with Marc Lipschultz, co-CEO at Blue Owl Capital. We discussed the growing dominance of private credit as traditional banks face stricter regulations and reduced lending capacity.
We first asked Marc to talk to us about Blue Owl and how they fit in to the private credit business.
Well, we've been very fortunate to be part of an asset class, and I play our role in helping evolve it. Look, private credit, to set the stage, right, is about taking long-term capital from investors, and we've tried to broaden the range of people that have access to it, and to be able to provide that capital to corporate users to support their growth with a view to the long term. And to be here on a day when the public market is so volatile, in some ways is very much a reminder of why private credit works for investors, but also why it's important. Because look, we're doing business today, we're making loans today, just like we were yesterday, just like we will tomorrow. Screen red or screen blue, or screen green. Prefer green.
Green. I should disclose that through my money manager, I do own shares in Blue Owl Private Credit.
Oh, thank
So
you.
I do have some of that. I feel like I need to say that.
Thank you.
But it's not through me, it's through my money guy.
Okay.
So help me understand the competitive landscape, though, because it feels like banks now want to get a slice of the private credit market that they had to give up. And now we're seeing some partnerships with private credit shops. How do you look at it?
Yeah, the evolving landscape with the banks is pretty interesting. Let's make a couple observations. The word, like referencing the bank market, I think is worth unpacking a little bit. Because as obviously you will know, when we go back to 30 years ago, I started in the private markets. The alternative market wasn't called that at the time. And we actually borrowed money from the banks when we were doing an LBO, as it was called then, literally from their balance sheets. That over the last 30 years has been on a long trajectory, changing from being a lender to now the banks don't lend to these companies at all. And that's been true for a while. They intermediate, right? They'll go in and they'll underwrite a loan and then sell it into the market, cut it into pieces and sell it. And so in that regard, of course, that's an alternative way to finance a business, and we could talk about the pluses and minuses of both. It's great to have both markets. You want to have a good, vibrant, bank-intermediated market. But remember, what the bank cares about is, can I underwrite the loan and sell it in the next 60 days? So the red screen is dramatic for a decision for a bank to underwrite a loan. On the other hand, we're the exact opposite. It doesn't really matter to us what's happening in the market today. What matters to us is, do we get paid back 5, 6, 7 years from now? That's our decision. That's what we're focused on. So in that sense, we really live in kind of with different incentives and serve a different function. However, to the good point, the banks are saying, okay, but turns out private credit really does work, right? They spent a lot of time criticizing the market and trying different ways to maybe scare up the boogeyman. But now they, in fact, are actually launching funds to do private credit. So I'd start with, look, if you can't beat them, join them, and that's great. We'll take the endorsement of the market. It's a big world. Credit's a multi-trillion-dollar asset class, multi-trillion-dollar marketplace. We need vibrant, available capital, and having a bank launch a fund, great. There's a lot of funds in the world, and some of those will be done in partnerships, as you noted, and some will just be standalone efforts, and some will just continue to stay the course and do their traditional underwriting.
What's a typical deal for Blue Owl these days?
So a typical deal for us, and this has been true for us from the beginning. Now, obviously, the attributes and the size have changed. But over the last roughly 10 years that we've built Blue Owl, our reason to be was to come in and say, look, we want private credit to become the lender of first choice as opposed to the lender of last resort. And private credit, if you go back before that time, was really a lender of last resort. It's where you went if you couldn't get money from a mainstream source. As I said, I was at KKR for 21 years. And during that time, I don't recall ever working with a private lender. That just wasn't what you did if you were a mainstream borrower. But the idea for Blue Owl and today, so to answer this question, has been to create actually a real value proposition in having a partner to really work with, a long-dated capital pool for someone who has long-dated needs and long-dated ambitions with their business. So our typical company today, often backed by a private equity firm, a sponsor. Sometimes it's just private family-owned businesses or other corporate enterprises, but typically a private equity-backed business. And they're buying a very large company, and they're looking for a long-term partner to buy it. So typically when we do a transaction, we're lending maybe 40% of the purchase price, and the buyer is putting up 60% of the capital. So that's it's a very, very low leverage structure compared to what people are used to. If you go back again, 10 years and 20 years. And the company today, our average company in our portfolio has over $200 million of EBITDA. I mean, these are big companies today. And that's been a dramatic shift from 10 years ago when it was really a market for smaller businesses.
So let's get to that 5 to 7 year time horizon, because 10 years ago, that's the exact same conversation I'd be having with private equity, right? And then we see where things get tough and things get stickier when vintages don't work out or they come under different times of market stress. How does that apply to the credit space?
So I think it applies for sure in the sense that every market evolves and every market will have its maybe slightly higher and lower moments, but there's an important distinction.
Okay.
At the end of the day, private equity, if I kind of use this metaphor, private equity, which is a business I personally participated in for decades, is about mining for gold, right? It's about going out and maybe in our simplified parlance, you might call them the get-rich strategies. It's how do you go out there and shoot the moon on great returns. So they're mining for gold. Our business in private credit is to be the picks and shovels provider to those miners. So we're not trying to find a big gold vein. We're not betting on the price of gold. What we're saying is if the miners are active, and miners in this case would be any corporate user of capital, so they are always active, we want to supply them, and we take a less risky position, and we expect a corollary attractive return. So on the one hand, of course, every market evolves, and I don't want to suggest anybody lives in a vacuum, but the purpose of our strategies and the purpose of private credit from an investor's point of view is to have something that's much more about downside protection, stability, and income generation through times of uncertainty, which is a bit why I say this sort of red environment today is actually a good time to have the conversation, because what we're trying to build our portfolios and successfully have done over $100 billion of loans, and our running loss rate has been 11 basis points. And I think it speaks to the idea that this is about durability and predictability when times are uncertain. And I think it's probably safe to say everyone's looking around saying, gosh, it feels uncertain out there.
Mark, we got about a minute left. What do you say to those folks who say, as the business evolves, the dollars get bigger, regulation is needed? What do you say to those folks?
Well, we're a highly regulated business as is.
Okay.
So, today, look, we're regulated by the SEC. We're a public company as a manager. We have public vehicles. We have a lot of regulators we work with constructively. Happy to do it. I don't think if what we mean by more regulation is more direction from sort of a central source as to what you should or shouldn't lend money to. Remember, when we look back where the sources of problems have been, they actually tend to be in the regulated institutions, not outside, even recently. Of course, everyone remembers the financial crisis, but don't forget, over the last few years, as private credit has thrived, one of the moments we worked through was the run on the bank at Silicon Valley Bank.
Yep.
So, what's old is new. If you have one-day capital and you do long-term things with it, that's challenging. We have long-term capital to do long-term things. So I think at the end of the day, look, we don't touch depositors. We're not systemic. So it's a nice complement to a traditional banking market and a public marketplace.
Our thanks to Marc Lipschultz, co-CEO at Blue Owl Capital.
Staying with Bloomberg Invest, Paul and I also spoke with Yup Kim, Chief Investment Officer at the Texas Municipal Retirement System. Now, he discussed how the firm is managing a more than $40 billion plus pension fund in today's complex economic landscape.
We first asked Yup what he thinks the best allocation is right now in what can be considered very strange, difficult economic environment.
I think on a very holistic basis, we are long-term investors, and so our long-term strategy remains unchanged. It's really predicated upon three pillars. Number one, attract, hire, and retain the best talent possible, and also attract and partner with the world-class investment managers around the globe. Secondly, it's really about taking a low-cost public markets, benchmark-aligned approach to investing. I do think we all recognize going forward there are more alpha opportunities, and beta might be, there might be some headwinds to beta going forward. So I do think increasing the share of active management in public markets will be a critical approach. And lastly, really endeavoring to generate a lot of the outperformance going forward in private markets will be absolutely critical. And so I do think kind of with the confluence of a lot of market volatility, it's easy to be swayed left and right, but I do think kind of sticking to your core long-term strategy is, very important in this environment.
How does an asset allocation work for you guys down in Austin? Stocks, bonds, alternatives. What role do alternatives play?
Absolutely. Look, I think when you think about alternatives, the delta between a median manager and a top 5 percentile manager in alternatives and privates can be upwards of 1,500 to 1,800 basis points. That equivalent number in public markets is 250 to 300 basis points. And so you are really compensated for good manager selection, but also good deal selection. And so I do think there's still, when you think about the next 10 years, there's a lot of equity value creation that will occur in the private markets. And so it really, kind of provides that long-term, kind of alpha engine to the overall portfolio.
I mean, it's no surprise that you did private equity in your last job, and then now you're taking over the Texas Pension Fund.
Correct.
How well funded are pensions right now?
Yes, and so pension funds are definitely better funded, kind of really on the backs of 2 incredible years in the equity public markets, and I do think public pensions typically have higher allocations to public equities, and so that's certainly helped. At Texas, we're above 90% funded, and so and just given that we serve cities that are growing, our net cash outflow for the past 2 years has been less than 1%, and so that really empowers us to harvest the illiquid premia of our private markets book, but also really helps us risk manage on the liquidity side.
How do you feel about just the opportunities today? Where do you guys see the best opportunities?
Sure. I think maybe 3 things I'll share there is, number one, the core building blocks on why people were excited about this U.S. exceptionalism, the core building blocks have not changed, right? When I talk to my peers in Asia and Europe and the Middle East, the U.S. continues to be the top destination, for their investment capital. You have the top academic institutions in the United States, presumably, with the greatest founders, the most tenured management teams. You have access to cheap energy. You have a risk-taking culture that's celebrated. That's really not found in many parts of the world. And the question we ask is not how do we generate outperformance in 2025, but how do we generate outperformance in the next decade? And we do view the U.S. to continue to take an asymmetric share of that equity, value creation in our total portfolio.
Our thanks to Yup Kim, Chief Investment Officer at the Texas Municipal Retirement System.
Coming up on the program, we're going to break down the evolving role of quantitative finance and artificial intelligence in asset management.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We continue with some of our best interviews from our live broadcast at Bloomberg Invest. We talk with leaders in asset management, banking, wealth, and private markets in the heart of New York's financial district.
In this conversation, we spoke with Bin Ren, CEO of the London-based fintech company SigTech. Bin discusses the evolving role of quantitative finance and artificial intelligence in asset management.
We first asked Ben to give us his quick pitch on what SigTech actually does.
SigTech, we build specialist AI agents these days to help people make better decisions in capital markets, but also to automate a lot of the very high-value intellectual but not very creative workflows. We can reduce a lot of the things people do today, which are a bit boring, down from many hours to 30 seconds. I think that makes a big difference in terms of productivities.
All right, here's an example that I can think of from my
Okay, tell me.
being at the printer, not far from here, a couple blocks from here, Don Lilly, at the 2-3 o'clock in the morning, going over a bond prospectus. That's probably something that AI can help with. So, Ben, how much are asset managers, generally speaking, how much are they using technology today? How computerized is it? How quantitative is it?
I think in the last 15 years, there's a big trend in asset management to adopt more and more technology. And we can see this shift in terms of people using more data-driven investment processes, and people hire data analysts. But Gen AI in the last few years is a big step change. I would say it's a unprecedented change in this trend. Just in terms of it's no longer incremental. There's a before and after. And when we think about previous technologies, we mainly focus on what we call explicit knowledge that we can codify, describe, and therefore use programming language to automate. But only until now, we are able to distill and automate so-called tacit knowledge, the knowledge that resides in our head, but we can't really so easily write it down and describe and codify. But now we can actually automate those, and there are plenty of those workflows and processes, especially in financial services.
So how would you help like a regular quant manager? Like I go to you and I'm like, hey, I need your product to help me get better, faster, find better trends in the market.
Yeah. For quants, I think quants started with more number-driven. Trend following if you do it like in a very simple way, it's entirely number-driven. But these days, we are moving to a world where we have to deal with numbers and text as two modalities at the same time. It's no longer just about technical analysis, but it's also about absorbing new information and turn non-numerical information into numerical information. And that's something that Gen AI does really well. Because fundamentally, if you think about how it's trained, it has been trained on trillions of tokens of textual data. And a lot of things we used to do in a bespoke or proprietary fashion, these days we get out of box, such as sentiment analysis or extracting relevant information from very long pieces of text. These sort of things actually change how quants approach their daily jobs.
Are the big Wall Street firms making these investments, or is it more the hedge fund community that is more receptive? Who are your customers typically?
These days, we mainly focus on buy side.
Okay.
But we also have very big clients in terms of like commercial banks, using our technology to completely change how they underwrite commercial loans. I think so. I wouldn't say it's a sell side or buy side or big firm or small firm. I don't think that's the main reason in terms of adoption. I would say the main reason is the leadership. When you approach something so unprecedented, it takes some time to build a consensus inside your organization about what's the strategy, what do we do. But that may take 2 months, 3 months, and given how fast things change, after 3 months it's a different world.
Yeah.
Right. So it really takes some kind of a conviction from a visionary leadership team to adopt this technology very confidently.
Yeah. After 24 hours, it can be a different investing landscape. So what's the best partnership between AI and humans? 50-50? Is it AI 75% of the decision-making process, 25% for human? How do you think about that?
Yeah. I think if I think about the knowledge work we do every day, I would describe them as most of them maybe not creative, but intellectual, right? Analyzing a lot of documents, picking out the right information. It's intellectual, but it's not creative. So in the future, humans should devote almost all their time to creative stuff, what makes us different. Whereas the boring intellectual stuff can be automated by AI agents. On the other hand, we are certainly seeing a big change in the user experience, the user interface, because up to until this point, people approach Gen AI mainly through a chatbot. There's a chat box, you type into it, you get some response. It's very nice, and it's really started the era. But going forward, we are looking at a user interface that allow a human to essentially collaborate with a large number of AI agents who specialize in different things. So how does that user interface look like? And how does that AI-human fusion intelligence look like? It's a very active field of research, trial and errors.
So this sounds like, from what I understand of AI, a lot of computing power requirements. Talk about the investments that you think these financial firms need to make, are making, or maybe need to step up.
Yeah. In terms of intelligence, the way I think about it is it's very similar to electricity.
Okay.
So we are currently in the first stage of investing in the infrastructure. Right? And if you're going back in history, in the last 200 years, the way we started building electricity grid, there's one magical number, which is 1%. The countries throughout the history spend about 1% of nominal GDP on building power grid, from 200 years ago in Britain all the way to today. So the big tech this year announced $300 billion of investment into Gen AI data centers. That's almost exactly 1% of the US GDP today. It's about 30 trillion. So in terms of infrastructure investment, we are there. And people are building incredibly big mega AI clusters across the country. Now, but we are shifting toward the application layer, right? Because once you have electricity, it's not about electricity per se, it's about what kind of appliances you can build powered by electricity. So we are moving into that stage too, where there are a lot of investment, both in terms of talent and capital, into building the right applications that can actually make a big difference to the knowledge workers in terms of productivity. So we are starting that phase.
Last question here for us is, what's the biggest misconception right now when it comes to AI and using it?
I think the biggest conception is, I think people tend to either underappreciate its capabilities, or sometimes getting over optimistic. It's quite hard to get it right. It's
like too much or too little.
Too much or too little. So I think most people are either under-hyping it or over-hyping it. It's very hard to get it right. But one thing is very obvious to us is that the pace of the change is unprecedented, and it's getting better. Like the DeepSeek just introduced, open sourced all their efficiency engineering tricks to the whole world, and then everybody is going to adopt it. So all of this is pushing the efficiency frontier. So we're getting better and faster every day. So people should be prepared for the big change.
Our thanks to Bin Ren, CEO of SigTech.
Staying with Bloomberg Invest, Paul and I also spoke with Stephen Meier, Chief Investment Officer and Deputy Comptroller for Asset Management at New York City Retirement Systems.
Stephen discussed how his group is approaching market volatility, rising interest rates, and long-term pension obligations.
We first asked Stephen how he's been navigating recent months during economic uncertainty.
It's certainly been interesting, and what we try to do though is adhere to a long-term strategic plan. So for us, a lot of this is noise in terms of what's going on in the change of policy in Washington. So we're really trying to stick to our North Star, which is our strategic asset allocation. Again, we have multi-generational liabilities that we're trying to satisfy. So again, a long-term investment horizon and a long-term discipline. Now, having said that, our trustees and our beneficiaries and our participants do call. We have the privilege of servicing 800,000 public workers here in the city of New York. So they're concerned, so we need to stay on top of it in terms of just increasing the information flow of how our assets are diversified and they continue to perform as expected.
So how are they? Like 40-60 or 60-40, maybe a thing of the past. There's different mix in there, especially when it comes to alternative assets. What's the best mix?
We're about 35% in alternative assets at this point.
Wow, that's a lot.
Yeah. And that includes private equity, infrastructure, private credit, some small exposure to hedge funds and real estate. Of this other 65%, we're about almost 40% of that is in equity, dominated by U.S. equity, about 85% U.S., large cap in particular, and then an allocation to developed market ex-U.S. and emerging markets. So we're balanced. We're balanced from a private perspective. We're balanced from a public perspective. And again, I think that's going to benefit us over time with the increase in volatility.
Have you changed your views on the economy, either the U.S. economy or global economy, given some of these trade tensions that are coming into the marketplace?
Well, we're concerned about inflation, and we do think we have some natural hedges of against inflation in our portfolio in terms of our real asset allocation, real estate, infrastructure. I think our public equities will actually perform well over time in a higher inflationary environment. So we're not necessarily overly concerned. We did expect to see some uplift in inflation expectations given concerns about the imposition of tariffs, the mass deportations that were talked about anyway in terms of potentially impacting the price of labor. So again, haven't really changed what we're doing or how we're doing it, but we're certainly mindful and we continue to monitor the situations.
Before we let you go, you mentioned 35% in alternatives. Seems like a lot. Is there a liquidity issue there?
Not really. Compared to some of our peers, and I know other institutional investors, we're just under $300 billion in assets. So I understand that there are other managers out there that have 40, 45, 50% allocation to alternatives. We have ample liquidity through the 65% in public markets. Again, we're disciplined in terms of putting money to work over time. We're benefiting from vintage year diversification. We've actually been putting more money to work in private assets over the last 2 years with a change of our strategic asset allocation, which has been beneficial as others have pulled away from the markets. We've been actually putting money to work, getting better economics, better access to the top managers, co-investment as well to average down the fees and expense.
Our thanks to Stephen Meier, Chief Investment Officer and Deputy Comptroller for Asset Management at New York City Retirement Systems.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.